even if that's something that the normal person would actually do. If you are a prudent investor, a sensible businessman, will you really let Mr. Market's daily communication determine your view of a value of $1,000 interest in an enterprise? Whether that be a $1,000 stake, a $50,000 stake, or whatsoever, or $500,000, only in case you agree with him or in case you want to trade with him, you may be happy to sell out to him when he quotes you a ridiculously high price, and equally happy to buy from him when his price is low. If you don't like both, there's actually an option. Do nothing. The rest of the time, you will be wiser to form your own ideas, value the holdings based on the full reports from the company, its operations, and financial position. So how are bear markets? No panic, no sell, no sell, no loss. This is what a company did, or an analysis did in the S&P 500. Let's assume that this is an index fund. I'm understanding most of our watchers are actually not index fund holders, but are individual shareholders. That's why we're going to go into each company's earnings in this free Friday class, at least the consumer cyclicals in focus. Nonetheless, you could see that there are huge percentage declines in the S&P 500. But if you have been investing, that $1,000 eventually became $1.2 million. Of course, we're not going to spend the rest of our 70 years. But the point is that bear markets actually occur. And there are things that matter on the long term. They're completely meaningless in the short term. Valuations are a very good example. Buyers don't usually care on the way up. Sellers don't care on the way down. I was telling somebody that during the pandemic 2020, people were going out and about buying tissue papers, and they were selling everything for a peaceful sleep. I'm pretty sure that people who have stock markets every day going down 10% every single day, they're not having a peaceful sleep. But it's easier to get caught up in narratives and story, but nobody knows why stocks are going down every single day. Whether it be Taliban, Afghan, or inflation or Fed tapering fears, nobody really knows when it's going to turn around. But it's important to say, investing is never easy. Drawdowns are the cost of future gains, and every successful investor would have their fair share of receipts. So a few things. This came from Michael Batnick from Barry Ritholtz Asset Wealth Management. You could see that the drawdowns have been fierce, sometimes 39%. It's really hard. So here, crash, not burn. The S&P 500 has lost more than 20% of its value 12 times in the last 70 years, but it's still up 15,000% or 100. What's that? 150x. So let's understand the reason why we like a company in the first place. Let's ask ourselves the same Peter Lynch question. Know what you own. Do we have a remarkably sticky user base? A few earnings reports today are showing that if you ask me, name a company with a remarkably sticky user base, after reading a lot of results, I'd say that Hims fits that bill, Square fits that bill, Roblox, Unity, Palantir, SoFi, Alibaba, Tencent, JD, Pinduoduo, Bilibili, Kuaishou, Facebook. That's just an example. Of course, you could answer Amazon as well, remarkably sticky user base. But ask yourself the reason why you own a company, and if that thesis remains true, even if the volatility is there, you want to actually ask yourself why you own the company in the first place. So a few questions. Did the company still have a sticky, loyal user base on their I was actually reading through things. So for instance, you own a company like Tencent. Did the company still have a sticky, local, loyal user base on existing games? Yes. Does the development team still likely to have a hit game in the future? Yes. Was the stock undervalued? Yes, even more so. It doesn't have to be existing games. So whatever that industry, does the company still have a sticky, loyal base? So all of the despair in the market, if ever, was actually just noise in the long term. Of course, that long term could be 2 years or a year. All of the despair and investors are exasperated, stock plummeting another 40%. By definition, investing can be a lonely process. Oftentimes, you even feel stupid why you continue to own a stock that has fallen this much. But a rock-solid conviction of why you own it, you would have followed the herd and cut losses without that conviction and why you own the company in the first place. In summary, you have to know the stocks you own, You know why you continue to own them. Of course, you're going to constantly buy and verify. Let's say you don't have any buying power, doesn't matter, but reevaluate the thesis. That is the most crucial tool to keep investors on track and disciplined. And if news does not really impact the investment thesis, then it's just noise. If the new data gives us higher conviction or higher concerns in our investment thesis, nothing matters more. Of course, new data will still allow us to constantly reevaluate, even after all the not successful, even after all the regulatory frameworks happening right now with many Chinese stocks. I continue to believe that if you're invested in companies like Futu, for instance, or a company like Pinduoduo, or even a company like Tencent or Alibaba, the latest news of regulatory framework until September 1 does not actually merit to me another 10, 20, 30% sell off every single day. So although Alibaba is now trading at about new lows, 2000 breaking below 2013 levels in terms of P ratio. This is not actually defending an Alibaba thesis, but it's just an example of asking, know the stocks you own. So another question that we will have to answer with our positions is, do I really understand what's moving the stock price? So Chinese stocks is kind of aware that almost everyone in the July, August, people who are holding on to their Chinese stocks are pretty much aware that this has to do with communistic efforts, socializing the profits. And day by day, you're seeing that the companies are getting ahead before China actually asks them to pay. In a case, for instance, just yesterday, Tencent reported that while they are wanting to be ahead of the game, what I mean is they did social AI recognition for how many miners they have in their revenues. They handled an insider buying yesterday, and they continue to actually spend 15 billion yuan, and this is going to be their social philanthropic efforts to continue with the China's efforts to bridge the gap between the super rich and the middle class and the poor. So in my view, that is a very proactive approach on Tencent because they're anticipating that whatever the Chinese government would have to do, it's better to actually proactively stem that fear rather than people get a bulaga or a surprise. Hey, what's this thing that China needs to ask from Tencent tomorrow? So those are, in my view, a question that most investors have to understand. What is moving the stock price? Whether that news merits a 50% drawdown or a 70% drawdown, it is subjected to a question based on a person's investing standpoint. You think that a Chinese communism valuation merits 70% drop? Or is it just 30% drop or 40% drop? So where is that view different amongst Asians and Westerns and those who hold the company in a short-term and a long-term manner? Now, do I understand how the company earns money? Does the company really have a clear competitive moat? There are many pressures to sell a stock, especially when it's declining, including fear of losing more money. Like, why don't I just nuke it and then buy it back September 2? Of course, that is a very speculative risk, which is, you could be correct, 50-50. It's a coin toss. How many people sell their money, sell their positions, and while it's falling down, the trend is continuing to fall and fall and fall. So there's herd mentality, peer pressure, complaints from clients, risks that things may get worse, and you may catch a falling knife. Every single day when Chinese stocks are falling, and I think there's so many unknowns, these are pressures to continually sell a stock, even if it may not actually fit the 1, 2, 3 questions on your investment thesis. So those are valid questions. So always verify the evidence. Always ask why you continue to own or when you decide to sell a particular company's stock. Identify the importance of staying true to your investment thesis. Understand the movement of a stock price up or down may not reflect the company's true value. So what is the probability of a downside event and what is the maximum potential loss you might face in such a scenario? In particular, a lot of companies today that have raised their guidance continually fell. So we will discuss, last week we talked about companies like Clover, Origin Materials, Open Door, what was it? Hims and Hers had great guidance. Even Luminar Technologies did very well, but it just sold off another 10-15%. Most packs have a winter sphere. Good earnings, sell down. Bad earnings, sell more. So it's like everything's just getting sold down in mass. At the same time, in Chinese stocks, we didn't see any bad earnings from Alibaba, Tencent. Bilibili also did not disappoint, but obviously, even after good earnings or beating earnings, the market still continually sold them off. So the probability of a downside event in any earnings call down nowadays is like 99% sure that's going to fall further, even another 5% or 10%, whatever earnings report comes out. It was actually a little bit of a volatile event, but next week is earnings of Pintuatua and Futu, which we expect to be growing. But we also are aware that from a technical sense, there is no bottom yet since they have broken down many crucial supports. In terms of Futu, they broke $100, which is like a 6-month area of support. In terms of Pintuatua, they broke another low last Friday. Well, yesterday was trying to retest the $75 area, and another new low today could actually pummel it down to new lows. So it is really just in a nowhere zone. It's like in a no man's zone. A few things to understand again. Will the company beat earnings expectation in the next quarter or in the next year? If you want to survive a falling market, assuming this is going to be 12 months further, if the company you own is beating earnings in the next quarter or in the next year, even if it doesn't actually stop falling down, and even if you don't have any more money to buy more, you have to just ask yourself, what are the catalysts causing the company to beat earnings? Because over time, what is attractive today, even if it falls next week, could make it actually tempting, not necessarily to you, but tempting to other investors who are sidelined, who want to actually buy a company beating expectations and trading at attractive valuations. In particular, Tencent is doing share buybacks recently. And we can see, sorry, I didn't put up the data, but there's data points right now that a lot of companies, even in the US, are holding approximately $6 trillion in their cash, because when the pandemic 2020 happened, most of them tried to raise a lot of money. And of course, it's prudent for many companies to raise money, even if they were cash flow positive. They're actually now favorable in making a buyback if they are allowed. Because last year, they withheld dividends. They stopped doing buybacks. And in general, most of the CFOs of these companies just wanted to keep the money. In particular, an earnings surprise that happened last night was department stores. Macy's beat a lot of expectations and are now giving a potential dividend when nobody actually expected a department store to actually issue dividends. So they could actually do share buybacks. There are some companies beating earnings, and it's important to actually think tomorrow and today, hey, there's a lot of ongoing bargain sales in a market nowadays. Let's understand, how will there be a catalyst if this company stays here for a long time? What will make it go higher? So paint a picture how, when, and why there will be a catalyst supporting your view that it's really cheap. Provide an opinion without fully understanding, explaining the relevant value drivers will be a recipe for failure. So what is your confidence that a company will beat earnings, and what's the probability? Nowadays, you're actually able not to even have a confidence that a company will beat earnings because the company itself is willing to raise full year guidance. We are seeing companies raising guidance for the year 2021 and 2022, and they're not actually absent, because you can actually correlate all those earnings reports from several sectors one by one with other people and what other CEOs in the same industry. So we'll see that, and I can see that consumer cyclicals as a sector, US, China, and probably I haven't seen Europe, but Europe right now also reported a good number on Marks and Spencer. We are really seeing some global recovery, although bumpy. What is your margin of safety and what can go wrong? Obviously, if the stock continually goes down and goes down, you could see your margin of safety being more comfortable, even if it is down 30% or down 40%. Now, Another thing to think about, crowded names will still work, but investors must tread lightly. When the market sells off or there's a change in sentiment, crowded names will typically perform the worst. To check, there's of course an index of high hedge fund ownership stocks. Nowadays, we know that most people are really sticking to quote unquote high quality companies. That's why we continue to see companies like Google, C Limited hit all-time highs. And I would agree that people are actually feeling safer to actually stick to all-time highs or great numbers because of safety. Like you're seeing that happen on upstart, fintech companies in general. Nothing wrong with that. We would argue that Square, PayPal will continue to dominate, and it is a crowded name, but it could still work. And we are also comforted about the fact that all of the signals, chart-wise and fundamental-wise, are all on the positive side. So other technical tools will help evaluate the stock if it's over-owned or not. So example, these days, it's arguably many people who already own Palantir increasing their shareholdings in Palantir, or people who already hold a significant portion of Disney, and after reading the earnings report that was released from Disney, they're adding more. So usually these are good, helpful tools. How much momentum can it continue to grow? These are just RSI. But I'd say that just looking at the chart itself, if it's just below 20% or less from its all-time highs, generally speaking, the winners will still continue to win, especially if the fundamentals are not pointing any slowdown. And chances are they're just going to go all-time highs. So Tesla beating expectations means that no matter your views, whether you're a Michael Burry shorting him, you have to think that the momentum is still on the positive side for the Tesla crowd. Ideally, you want a stock that has recently underperformed the peers, likely owned by hedge funds, and is heading into a catalyst that you think will have a positive surprise. By contrast, a crowded name that has already outperformed because of an expectation of positive catalyst will likely get a limited reaction if and when the catalyst does occur. For example, it's very common for companies to beat earnings expectations but not experience an increase in their stock price because the general public have already expected earnings surprise. I think that is what happened in general with some companies like Square, PayPal, and Roku. Good companies, good earnings, but it still fell nonetheless, like about 10%, even Amazon, because it was already owned by hedge funds, and any less than perfect result was actually not going to make these hedge funds or institutional funds happy. The good thing, if you actually are assuming the worst, is that the average length of a bear market is about 6 months, 10 months, 10 months here. So assume that the bear market happened February 2021. February 2021, we've been already falling down as a whole from the market. So it's either you use Feb 2021 until Feb 2022, or you use July 2021 until July 2022. Whichever pinpoint you have on the actual start of the bear market, I'd say that the positive thing is that we will all look forward to a recovery in 2022. So this one is a data that I've been looking at. Cyclicals have been recovering after an extreme outflow relative to defensives. Defensives meaning your consumer staples and your supermarkets. You have been seeing that cyclicals minus defensives are actually at oversold regions nowadays. This is just recent. So with fundamentals, and we're going to read on cyclical outperforming, I'm seeing that, number one, not all hedge funds are really betting on a recovery. Number two, the earnings are on our side, and the technicals are also near support. So if you're actually thinking, hey, is there an opportunity in a bear market? It is. So let's take a look at some headlines and some results. Just today, Marks & Spencer stock soared 11% after the giant of UK High Street raised their profit guidance for the full year, revenues recovering to just 3% below pre-pandemic levels in the second quarter. What was it that I was reading recently? I saw that a hotel said that they were 19% below pandemic levels. So like, I think it was Marriott Hotel. So that is something to actually be surprised about because it's not really priced in with the market. Last night, Macy's jumped 20%, and the big earnings beat came from this number. Let me just read to you. Let me read to you the actual results of Macy's here. So here, let's just go through the earnings report of Macy's. Macy's second quarter results, raising guidance and announcing a plan to return capital to shareholders. Comparable sales are up 60%, 62% on an owned and plus licensed basis versus last year, up 6% respectively versus 2019 or higher than pandemic. Raises full year and back half guidance, both top and bottom lines, authorizing a share repurchase program, buybacks, reinstating a dividend. So continued execution coupled with macroeconomic recovery. So there's a retail apocalypse, quote unquote, that's actually negated by just a great quarter. Second quarter results, strong across all three nameplates, surpassing all expectations. Momentum in the first quarter accelerated, successfully re-engaging core customers, attracting new, younger customers with new brands and categories, said Jeff Jennett. Through the Macy's and our omni-channel approach, we provide a compelling, seamless integration. Let's read further. Enhancing shareholder value. We just ended with approximately $2.1 billion in cash, allowing the company to execute on profitable growth and delever our balance sheet. The strong cash position allows us to return capital. We are looking to announce a nearly 200 million dividend at the close of September 15. This is a dividend of 15 cents per share. A quarterly dividend could be reinstated or 60 centavos. So that's about 3% even at $20. The company's board authorized a $500 million share repurchase program and also paying $1.3 billion in secured notes on August 17, 2021. They're also trying to achieve target leverage ratio, achieving no more than 2.5x by 2021. So this is a good report. We'll go through very fast surface headlines, and I'm gonna show to you some optimism in this consumer cyclical sector as a whole. So Macy's had its best day since 2020. Its earnings were that good. Reported average profit of $1.29 per share, far higher than just an expectation of 23 cents a share. That's 600% higher. You've got sales of 60% up year over year, beating estimates from $5 billion. Same store sales crushed 61% from forecast of 40% growth. So these were the results. Also, so let's think about everything that has to do with boomer industries, restaurants, supposedly hospitality industries, those types. Krispy Kreme CEO talks earnings, donuts, e-commerce business also reported good numbers. Let's try to listen the CEO talking. Hear about 1 minute. Watch this.
Shops, those hot light shops that a lot of the people around the world know, and then bring the hot donuts or bring fresh donuts to where the customers are in a fresh model distribution system. So really pushing on what I'd call points of access. And that's very different than what we used to do before. So it's getting points of access in an urban location. It might be in a fresh shop, it also might be in a grocer, and it might be in a convenience shop. And that also unlocks e-commerce. So that's very different than our past, which was a very typical franchisor model and just building out hot lights everywhere. We actually value scarcity, and the model now is really about, producing amazing donuts, especially the original glaze, and then making sure that we can get it fresh to where the customers are. That's the difference in the model, and you can see it in the international business, which has actually been developing this omni-channel model ahead of us, and that's what we call it, and it's part of the hub and spoke is part of it. And it was built and designed that way, and their profitability that you can see in Q2 was significant because the frequency from the points of access, including our hot light shops, really worked, and you can see that in the performance.
It's also a different model, Mike.
Okay, so an omni-channel approach was very much happily loved by the people of Domino's Pizza, Chipotle, Krispy Kreme. Advancing there is actually a great thing. Earnings, donuts, e-commerce. As simple as these types of businesses, we have to listen to the CEOs and we have to listen to the market. And last night, I think Krispy Kreme went up. Let's try to see. Actually, I'm going to report to you companies that are doing well, and not everyone is actually willing to bet on this cyclical recovery. So Krispy Kreme is actually a company that just listed in the market. This was an IPO, and from $22 fell down to about, what price is this? 13. Last night was $15 after, of course, that good earnings report. And I'd say that, of course, I can't say this is the bottom, but that is something that is positive, and I want you to actually go through the next few weeks or few quarters to actually be looking bullish, and we're going to have to focus on reading more of the retail, restaurants, and in general, we are going to have to be bullish on what the data is giving to us. Verify whether the market is pricing it correctly, and that one-day reversal can actually be a start of a trend for an uptrend reversal for Krispy Kreme. Okay, so anyway, we're not going to have to go through a Krispy Kreme deep dive today, but we are, of course, happy on these types of revenue growth. Airbnb, for instance, earnings, revenues rising over 300%. Obviously, the company is not going to be optimistic, raising guidance, but let's just listen to what happened on the quarter. Okay, here, let's go through.
Handedly topping expectations in its latest quarter, as you can see, but its guidance for the current quarter might have investors a little spooked. Let's start with the good news there. Reporting a near quadrupling of revenue in Q2 as travel bounced back from the lows of the pandemic. The company also, as you can see, they reported a narrower than expected net loss. But for Q3, Airbnb says it expects the number of nights and experiences booked to fall short of where they were pre-pandemic back in 2019. So for more on how that's impacting the growth story for Airbnb as shares move between red and green here, let's bring in Bernie McTernan, Needham and Company Managing Director, joins us right now. And Bernie, you seem unfazed here based on that potential Q3 slowdown. You reiterated your buy rating, upped your price target $6 a share to 200. So what makes this a buying opportunity in your eyes?
Yeah, look, we're willing to take the long-term view. I mean, what we did is that we took up our bookings estimate for the year by 10%, our revenue estimate up by 8%, and our EBITDA estimate by almost 40%. So really our two key takeaways from the print is that North America is just still really strong. So if you look sequential.
Okay, you can of course listen to them, but I would agree why the analysts are all upgrading Airbnb and sticking to price targets 60-70% higher than current levels of $140. Any dips on Airbnb, we are quite positive on the revenues, and we are positive on reopening recovery names. Let's see further. We knew about Nike hitting record highs after a blowout fourth quarter. Let's listen. Sector by sector, retail sales doing very well, forecasting 2022 sales of more than $50 billion.
Well, as we highlighted, shares of Nike are trading higher this morning.
So these are crowded trades because these are already all-time highs. But this tells you a bigger story that reopening and retail can actually do very well on an omni-channel approach.
Nike says for its full fiscal year, sales will be about $50 billion. Reacting to the earnings, it came in, things are basically firing on all cylinders for Nike. The sort of problem, as you see it, I guess, is the valuation of the company that's relatively expensive right now. How much would Nike have to be growing to sort of justify the price where it's trading right now?
Right now, it's trading at about 35 times forward earnings. So that's pretty aggressive, although not that unusual for Nike. So you'd have to be looking for earnings growth of 20+% really to justify that kind of valuation. And Nike can do that, but this is an industry that doesn't grow at that rate. So Nike would have to gain market share consistently over the next several years to be able to put up those kind of times when Nike stock price has had some difficulties, and I would look for those opportunities probably.
Okay, so what you want to know here is that because Nike is doing well, it told us that Under Armour and companies that are less how should I say this, also in the same secular trend can actually do very well. That's why seeing Nike earnings report do very well tells us that Under Armour is going to re-rate, and true enough, Under Armour went up. Good beat as well. It's very important that even if you wanted Nike, you have to understand it's a crowded trade, but it tells you that the sector is very, very strong. Listen as well to Adidas. There is uncertainty in China, but exceptional growth in other regions. Let's listen to Adidas CEO's reports.
Look, there's a lot to like in these numbers, I have to say, and I don't know why the pre-market is so indifferent to obviously what you've demonstrated in terms of good, strong sales line in most markets. Just give us the quarter as you see it, and maybe give us a line on Greater China.
Yeah, first of all, I think what we're most excited about is that sport is back, and we're really seeing that. We came off the Euro where football almost came home, the Copa where Argentina won, and now the Olympics. So you're seeing now people are, coming back into the stadiums, not with, with the rate that we anticipate because of Corona. So first, sport is back, which we're super excited about. Secondly, that we upgraded the guidance to the full year, so we're very confident we'll continue our expansion. And thirdly is we will have a very successful year. What we are seeing, North America, Latin America, and Europe having a very, very strong growth, and we are seeing uncertainty in China. But I'm very, very, convinced that China will be, very, very successful also for us this year. So we're seeing uncertainty in China, but in the three other regions, exceptionally strong growth. So overall, a quarter that we characterized, and we think it was a very good quarter for us.
Yeah, shame about the football, wasn't it? But you're absolutely right. It didn't quite make it across the line. Anyway, Kasper, what was interesting, I thought, was the e-commerce revenue line fell 14% here. As we're coming out of the lockdown, do you think that suggests a normalization in sales channel patterns? And what do you do about that?
No, I actually expect strong e-commerce growth also in the future. What you saw in the second quarter last year was a partially 70% lockdown in our stores across the world, where you saw an abnormally high growth in e-com. So I would not overread into that. We have a plan to grow our e-com business to 8 to 9 billion by 2025. So I would more look into the comparison in the second quarter last year was exceptionally high store closures, and that was the only channel. So I think you're just seeing a normalization. Throughout the year, we still expect very strong growth in our e-com channel, also following a very strong first quarter. So I wouldn't overread into it. It's more a quarter-to-quarter comparison.
We'll go through more results.
Look, there's a
Of course, you can go through these. Last night, Miniso announced June quarter full year fiscal results. Let's read through it. Also a beat. This is a fast-growing global value retail offering a variety of design-led lifestyle products. Results fourth quarter ended June 30, 2021. Revenue was $382 million, higher than the company's guidance range of 2.3 billion yuan. It is an increase of 60% year over year and 11% growth quarter over quarter. Gross profit is now $99 million, increasing 68%. Operating profit is growing now to about $29 million. Profit from continuing operations, $111 million, representing increases. Adjusted net profit up 240%. Operational highlights, number of Miniso stores increasing 4,750. They added 162 stores. Number of mini stores in China has grown to 2,939. Number of Miniso stores abroad is 1,810, which represents a net addition of 35 stores in a quarter, and one store in same period of 2020, an addition of 29 stores in previous quarter. They've also entered 4 new countries, marking their 98th entry into an overseas market. And after the Top Toy brand was launched, they also added number of Top Toy stores, increasing to 33. So a few things to understand from their table. They have directly operated stores here of only 7 because Miniso is in a franchise retail model. In June 30, 2,533, you've got third-party franchisees, 2,526. Overseas, you've got 1,689, only 122 direct operated. Third-party stores, 1,567, quite similar to McDonald's, mostly franchise. I'd say that the results are good. And this is the fiscal year for 2021. The fact that they're growing in a single year is telling you quite a significant jump on the overall retail sales category in China. So, and also recovering in the world. Miniso had a solid fourth quarter despite the rapid spread of Delta variant, triggering a new round of pandemic in Guangdong and some overseas markets. We managed to add 162 Miniso stores. Our strategy further illustrates to become a global leading new retail platform. We also launched Top Toy. In fiscal year 2022, we remain committed to the pursuit of strategies for store network expansion, product innovation, omni-channel experience. We've experienced accelerating recoveries in both domestic operations. The latest resurgence in Nanjing, China is still evolving. We are estimating that our sales will be pressured by lingering effects of pandemic in the short term, which will reduce traffic. Okay, sorry about that. Let's take a look at some things that we've been hearing and data, right? So around August 6, 2 weeks ago, we talked about bulls are back, charts attack, and our view was that, let's repeat. So we thought that airlines were actually growing, casinos, outdoors, because the data was giving us those names. EVs, unfortunately, we thought they bottomed out on Biden, but it got crushed yet again. However, all the earnings from solar companies actually beat and raised guidance. So in their farmings, we were wrong, especially in App Harvest. And what happened here for Grow Generation was unfortunate. Growth, but actually missed earnings. In terms of genetic editing, we haven't seen any results. But Intelia and Invitae did 100% growth. Intelia reports coming out next September for Editas and Intelia. Sports, just like Adidas and Nike talking that sports is back. So far, what we've seen in the sports is actually positive, but the market is still reacting on the downside. Like Penn National Gaming is now trading at $66. DraftKings at least steady. Genius Sport is still steady. How about travel platforms? Travel platforms like Expedia went down from 160 to 138, despite good numbers. Booking Holdings is now trading at about $2,100. Airbnb is trading at $140. We see an opportunity in travel platforms. Fintech did very well, earnings-wise. We saw great numbers on Square, PayPal. Paycom I haven't read, but Paycom also did well. I think it was gap up after earnings. So in general, fintech has been moving down over the last 2 weeks, but the numbers are giving the investors some good margin of well. Sea Limited recently reported last night, also made a good beat. Sea Limited hit all-time highs. Shopify is steady, consolidating at all-time highs. These are crowded trades, but we argue that the crowded trade here is not gonna end anytime soon. In terms of streaming, Roku and Netflix, we thought the numbers were actually good. Netflix was muted upon earnings results, but last night went to $540. Our argument is that Roku, despite people thinking that there's competition with Google TV, is muted, as Roku is really the dominant market share leader. So even with the dip right now at about $350, or even if it drops $330, our argument, I think, in the data, if you're going to use and verify with the business, is that these stocks can survive any prolonged bear market and actually come out on the safety of all-time highs in the future. I haven't read numbers on any of the cybersecurity companies, but one company there reported undeniable growth. Like I saw 300%. Shucks, I can't remember if it was CrowdStrike that I read. Maybe it was first quarter 2021 results. But in terms of cybersecurity, they're still bullish in the entire sector. And this is a crowded trade, expensive, but we are of the view that is still a correct play. Software names, crowded trades like Datadog and Atlassian, any dips we view will be bought. Enterprise software continuing to really be strong. Okay, in terms of additive manufacturing, there is a dilemma. Desktop Metal fell to new lows. From $9, it's now trading at $7. No difference in terms of earnings. It's becoming actually stronger. Nanodimension just reported their numbers this week as well. In terms of AM, as a sector, we see actually positive results, but the market has been ignoring all of them. In terms of biodegradable plastics, also positive. Origin and Danimer Scientific did very well, but the market still sold it down nonetheless. Origin is now $530, but we've seen insider buying happening. Danimer Scientific right now is trading at $14 in my view. But actually the company reaffirmed and even raised their guidance. So we see a discrepancy from the technicals and the prices and the actual company inside. So if you own it, I'm not saying that you have a bottom, but I think it's a feel-good consolation that you actually have the company businesses improving and sometimes even raising guidance. For Laser, they're gonna commercialize Volvo 2022. That means that they could eventually have level 2, all the autos of Volvo will be road safe, and it will prevent what, like they're saying, I can't remember how many accidents a year, road accidents. I think at least 1 million lives die every year. So if Laser can already deploy not 2027, but next year, 2022, that is a huge conviction on LiDAR, especially Laser. Among the 3 companies, I think the first for commercialization is Laser. And that's the reason why Laser is trading at about $15, higher than Ouster and Innoviz, double actually Ouster and Innoviz. Either way, I think that the sector is really showing self-driving and robo-taxis as a future for all of us, whether that be and because it's a direct EV penetration, direct correlation, I see actually less risk than what the market is pricing in for the LiDARs. Of course, we saw great numbers from some select airlines because these have already reported numbers. So Wynn Resorts did well, SeaWorld did very well, Six Flags did well, Disney. Some airlines did well, but not all. So either way, it's going to be bumpy for the airline sector. Genetic editing, I think we wait September for milestones driven by Editas and Intelia, but it's really positive breakthroughs from these two, which actually translated to strength overall on the genome sequencing. Oversold SPACs, it's such a downer. Sorry, At Harvest is deleted already because really bad execution. And then for the charging stations, positive move on ChargePoint despite the sell-off by the market. So we are still seeing that the market, upon these reopening stocks, we're still reiterating our buys, even if the world does not agree to us at the moment. So these were things that we talked about. Of course, these were the revenue guidelines. These were the race guidance. Let's talk a lot about the charts, though. So let's take a look very fast on the charts. So let's take a look on this very fast. So consumer cyclicals earnings results. This was July 2020. You've seen companies like Designer Brands, $6 then, Expedia, $90 then. This was a time when there was no recovery, but there were people hoping for a recovery. So it was even GME at $4 then. Okay, PVH was about $50 then. KSS, Kohl's Corp was $22. Macy's was $7. Now, this is November when we actually had Pfizer and Moderna vaccines. And the market, again, rallied strongly in a single day on the overall sector. Here you could see Macy's already trading at $8, still the same. That's why there was that real value in Macy's. And Nordstrom, $19. Nordstrom actually picked up. Nordstrom was 16 here. It was 19 here. Okay, so right now, we are actually going to compare if the results in general on the reopening stocks have been quite well. Is it possible to see some opportunities that the market is really not appreciative? Is there a delay, a lag here? Okay, so last night we saw Macy's 20%, Kohl's and Nordstrom followed suit. Urban Outfitters, H&M, Designer Brands are rising 1-4%. Take a look at some airlines. Although Chinese as a whole is like a bloodbath, Chinese airlines are actually trying to defy the math. You could see Trip.com at $25, at least not falling to new lows, which tells us also, forgot to say, Funko results are 130% growth, which we argue is a buying opportunity on dips if it ever collapses to $12 or $14. It's still falling. You can see 3% down. This is after hours. So I have also a view that while you think that digital advertising is people who advertise on Twitter are companies like retail and Airbnbs. So most of the companies that will increase their advertising expenses onto your Facebook, Google, Twitter is a company that is thinking that there is money to spend. So that's the reason why I put Twitter here, even if you might think, oh, Twitter is not a reopening stock. I think that Twitter is a digital advertising sector that grows, especially when we are reopening. That's also my theory with Square, that Square and PayPal are going to grow. And it's not about fintech dominating online shopping, but it's really fintech helping merchants on their behavioral process of selling better. Like if you're going to have retail sales jumping 50% year on year, likely the ones processing that is still going to be Square through their QR codes. So that's why I'm quite bullish that Square is a buy. Okay, so we are going to assume that these drops, 1% drops on Hibbett Sports, even Foot Locker, TVH, it's even outdoor venues like Live Nation, Party City, it could be an outperform sector. So look at the drops though. Right now, the biggest drop, you can see drops on the likes of Uber, rentals, Airbnb, TripAdvisor, American Airlines is down. This was last night. Delta Airlines is down. Southwest Airlines. So in general, let's look at it sector by sector, guys. Retail, we are seeing good results on Miniso. DBI hasn't reported numbers, so we are going to assume that any dips before earnings could likely surprise to the upside. Tapestry, Capri, Ralph Lauren, PVH. Department stores as a whole have rallied, even if Macy's was the only one who reported numbers. Airlines, I think some people are bullish here. Tourism, we are seeing good results all throughout the three. In terms of oil and gas, I am a little bit skeptical. But there could be outperformance. Heavy dining restaurants. We saw performance in the likes of CMG, the Domino's Pizza. Haven't read the results on the rest, but I would say that these omni-channel programs are doing well. So maybe on the heavy dining restaurants, we have to include their Krispy Kreme donuts because it's new. As for non-essentials, that is also our view that when you are having money to spend, you will spend even on medical aesthetics, which is positive on Shentra and InMood, and toys. So we're positive on toys. In these group, I'm very positive on Funko not getting priced the right valuation nowadays, despite the growth of Loungefly products, which grew 132% in the second quarter 2021. Casinos, Scientific Games just grew 300%. I haven't read the reports here of the rest, but DraftKings is doing quite well. I'd say there's a buy and dips here. And then on the casinos front, I'm of the view that Wynn and MGM and Boyd are doing better, and Penn. LVS, the problem here, it is the dog in the sector in casinos because Las Vegas had a lot of delays on their Marina Bay Sands. So it's company specific. But we are of the view that we have to read more and verify these businesses, but quite positive in these sectors. Okay, so let's go through these earnings charts. So designer brands, this was a breakout 660. Oh, sorry. 660 here. And that was around November. It was still 9. Designer brands is now trading at about 12, 13. So let's I guess you want to go to the charts. So let's go through the charts. Where's my chart here? Here. Okay, so we still remain positive. Let's look at it sector by sector. So we think designer brands will actually outperform by next August, September. We see any dips actually a buying opportunity. Let's take a look on them one by one. So TPR Tapestry can actually potentially be, haven't read the earnings, but we think that there will be a lot of buyers. TPR, CPRI, let's see. So there is drops, but notice they're actually off very high from their September, October, November lows. So there will be corrections in case it's not good, but the sector in itself is quite positive. Ralph Lauren, okay, PVH, let's see, each stock, sector by sector. So apparel, retail, Under Armour will be a buyer on dips. Wait, let's take a look at that. So designer brands is already double now. PVH, which is Tommy Hilfiger, Calvin Klein, let's take a look at that. PVH still at all-time highs, near all-time highs. So you've got less resistances on this group. Yeah, so from a very bearish drop last year to actually a sustained reversal with momentum catching up. Capri Holdings is trading right now at 53. So any dips, maybe it could drop to 42. We would view an entry. Wait up. Tapestry is quite high, right? So still need some entries. But the beautiful thing about this, the sector is outperformed. Urban Outfitters hasn't reported numbers. Urban Outfitters, this is a consolidation here. So it could fall to $30, but earnings on August 24 should see more of a bullish trajectory on these names. Ralph Lauren, okay, Ralph Lauren was about $75 here. It's about 100, I think, nowadays. 114. Should there be a drop to 100? These are more high conviction buys because the sector is doing well. Nordstrom, yes, during that time, 16. How is it now? Is it $30? JWN, 33. So either way, even if there was a doubling already, because the results will confirm, this will continue on and on. So it depends how good their results will be, but the view is positive. So Macy's, yes, this was a strong buy here at 6, 7. I remember there was a Czechoslovakian billionaire who actually bought a lot of Macy's during these levels. But I think he sold. I'm not sure if he's still holding. Kohl's is now 30 plus. Okay, Jets ETF. Okay, so Jets was trading at about $17 here. So far, the airlines have not really moved up. It's just 23, 22 nowadays. Look at Jets ETF. It's trading at about $20. So this was the breakout here at 17. We'll see how low the markets are really gonna fall. But our assumption is dips on airlines will be bought. It will be bought by people who believe in reopening because of the statistics that they're seeing on the market. So those are for your airlines. DAL, Save, UAL. There will be bad news every now and then. But there's also a buyer. Booking Holdings was 1.8 here. That was July. And it was 2.1 during November. Nowadays, with more evidence that they're earning money and actually recovering, it's still at 2,000. So you could argue that there is lagging on Booking Holdings, which means that some people might actually buy Booking Holdings, given that at 2,100, it's quite the same as you buying during November. So this is more of a better buy because it's still lagging behind. TripAdvisor's was 26 here. This was about September 2020. TripAdvisor nowadays is 30. So it's not really that huge of a premium. Was trading at 26 here, 25. So even if there are dips, I'd say there will be contrarians. Let's watch whether this 27, 28 for TripAdvisor is going to get bought. Could be, because you're seeing strength on the travel platform bookings. Expedia is right now trading at 130. So Expedia is actually a buy, of course, even if it drops to 120. Assume you have, you shouldn't panic. Sure, a drop can actually take it to 138 to 120, but the results are with you. Okay, this is oil and energy, but I think almost oil and energy are already high. So this dropped. So Earthstone was a buy somewhere here about November and October. December, about $4. It's now double. We'll see whether there is an entry point. But we're bullish on these names because they manage the downturn by selling the oil at forward. And we do think that no matter how bullish we are on electric vehicles, it's not true that all these oil and energy drilling names are going to just collapse to zero. So especially if they're well managed. So there's just two picks for us, which on this oil department, it's just S10 OYI. OYI, this was then at about $6. Sure, it dropped. Now it's about 11. So that's still double, but any dips, we will see a buying entry on the cyclicals. So we're going to hunt into the cyclicals. Restaurants, okay, McDonald's became a safety net. Consumer staple, positive. I think McDonald's now is trading at all-time highs. Yeah, it's at all-time highs. Consumer staples, restaurant brands, QSR, also at all-time highs. Not yet. This was 70, but should be on the positive side. We're bullish on the sector, on the restaurants, fast food as a sector. Chipotle is now trading double. This is 1.1 here in July. It's now trading at 1.9. So quite expensive, crowded trade, but still continuing further. So 1.9, double. Yum China, okay. Yum China is a positive thing. So this could be a play on restaurant. We're bullish. So it's falling 58, could go 56 with all the Chinese behemoth drops. You can even argue that you might want to look at Haidilao Lao in case you want. 6862 is trading at $27. Could even fall to $20. We're quite contrarian here. And Nayuki, 2150. It's now trading below 10, right? 986. So this is a new company, IPO, just similar to your Krispy Kreme. So this is a milk tea company in China. So with all that drops in China, there's a huge sell-off everywhere. I think that the fundamentals of Nayuki is doing well. And of course, Miniso can actually look at that retail below 18. Now trading at 12. Hard to find a bottom nowadays in China. Fundamentals doing well though. Tcom, Trip.com, okay, it rose last night. Good job. So we really are seeing that airlines, people are actually picking up the airlines yet again. This is an evidence that despite all the China's problems, Trip.com bookings, we are seeing some growth. First sign of reversal, Tcom. Look at 670 again, Chinese Airlines. So we want to actually confirm our fundamental view with the fundamentals, with the technical. So we don't just buy anytime. We want to actually see that buy bullish reversal for an obvious move on the upside. 670 has dropped to 270. Our view is that these are reversals on the move upwards. 1055. Bottoms are not easy, but give it a few months. I think these are bottoms. The $4 for 1055. So if you have Tcom, I think that you would be buying more at 25 if ever there's drop, or you buy at 26.50 tonight. Let's go further for some charts. Shake Shack, yes, this is $50 here. It's now 85, similar to Krispy Kreme. Also e-commerce. We are could even go $80, or yeah, it could fall $80. You might want to actually buy some of these reopening stocks. Starbucks is quite expensive. This is a crowded trade, just like Nike. So you might need to get some pullbacks before you enter Starbucks. Wait about $105. So try to buy low, not because these are crowded. Darden restaurants. These are heavy dine-in restaurants. Yes, DRI, just steady, consolidating. Papa John's is new highs. Right now, this is trading at Papa John's is trading at all-time highs already, 127. Can't chase. Domino's Pizza is trading at all-time highs, just like CMG. Can't trace them. Dunkin' Brands, I think this got privatized. We can't, yeah, there's no Dunkin' here anymore. So if you want donuts, you just go for donut, D-nut, Krispy Kreme. Sientra is medical aesthetics. This represents consumer discretionary. These are boob implants. Whoa, it fell down to 5. Okay, so might want to actually check whether earnings on the levels of 5 is actually going to be bought. So thought that $7 here during earnings last time was going to support. We'll see. But apparently, some people aren't actually going to the medical aesthetics. We'll see the earnings report. Oh, I haven't read. So it shot down, negative. So apparently nobody really went to the hospitals again. No medical aesthetics. Okay. In mode is 34 then. How much is in mode now? All-time highs. So people want to lose weight. Okay. Jimmy, Jimmy is $130. Okay. Hasbro is strong. Toys, yeah, this is $100 nowadays. So leisure, 95. Anyway, dips will be bought in our view. In terms of opportunity, I see an opportunity here in Funko. It could drop to about 14 though. So in case you assume that the market will continually fall, a better buy would be, any drops near 12. Let's say you want to buy lower. But yeah, so either way, one and actually check how low things go because we see a reversal here. What else? Boyd Gaming, casinos. Yeah, let's take a look at casinos. Casinos in general have been doing very well, very strong. Boyd, MGM, strong. Wynn has fallen down. That's why I think this is an entry point. Caesars, not fully dropped, but these are consolidations that we view as a buyer. Boyd, Wynn, Las Vegas Sands right now is dropping to new lows. This is company specific. The lace for Marina Bay Sands and debt. So I think Las Vegas, we don't want to actually intervene. Macau, I'm not willing to bet, not yet. So these are actually Chinese casinos, not yet. Results from Macau isn't good. Okay. So I wouldn't bet on Chinese listed casinos. Penn National Gaming, even if this is a double already, July 2020 is 34. Penn National Gaming, in my view, has been improving. Here about 65. I would say this is a buying opportunity. Let's read further on Penn's results. Penn National Gaming results. August 5, second quarter revenues of $1.5 billion, net income of $200 million. Penn National Gaming just also acquired a company for streaming. So they don't want to just go for online betting. They also want to be a streaming platform, especially for sports niche. I'd go further into reading more into Penn National Gaming results. But the point that I'm making here, guys, is that if you look closely on many reopening names, some have doubled, some have stayed there, but the results have been doing quite well. So Wynn, I think you can buy lower now at about 88. That should be a good opportunity. Trip, well, this was actually July. I made this November because I was like looking to buy those before. And I'm just more reiterating buys on some of these names because some of them actually are giving opportunity. The opportunities today remain buoyant. So maybe after today's earnings calls, spend more time going back to booking.com, Airbnb, travel platforms, and then some oversold Chinese names, some Krispy Kremes. I think that's good. And then let's take a look on, so I'll write it down here. Sorry, I forgot. Okay, from the chart setup itself, so outperformance, read further on Krispy Kreme because I think nobody is pricing it carefully. Funko, maybe a retail. I need to read more retail news, and more restaurant news. Not everyone has been priced perfectly. Either it's the Heidi Laos of the world or let's say you want to really avoid China. So let's not talk about Heidi Lao or Yum China or Nayuki, but I think there's an outperformance there. Actually, let's still read it. We have to, because just because everyone hates China doesn't mean it's really valid. People gotta eat Hai Di Lao, Yum China, Nayuki. I'd read those numbers, and then read through a lot of shopping data points, and traveling data points. Think and Penn. Sorry, I want to study Penn National Gaming. And then really, I'm going to reiterate more bias to buy your Disneys, Airbnbs. I don't think like people have to really worry about these types of names. Thank you, guys. I think I'll answer a few questions. What do you think about APPS? I haven't read it. APPS, Digital Turbine, is about digital advertising. If they would show results growing, I haven't read it. I can't answer. But my bias is it should be positive on the entire digital advertising community. If you're thinking reopening, it can't just be Google and Facebook getting all the market share. There's no updates on Humble. Somebody's asking me about Humble. I don't see any updates on Humble. I can't quite say anything. So in terms of crypto projects, I think try to focus on companies that are getting a lot of sales. I just don't. I haven't read, so I can't quite say anything about them. In terms of Electronic Arts games, that has been doing well. EA, Activision, Take-Two has been positive. It is, in my view, gonna go higher, most especially for Electronic Arts. We saw the numbers on EA, quite positive. But I'm not sure if it will really outperform. We are quite neutral to bullish side. Why neutral? Because if more and more people are going to spend their time outside home, the view is that you're not going to spend a lot of time playing games. So it's in direct opposition from people who are betting on the reopening cycle. That said, of course, I don't want to actually be too polar, North Pole and South Pole. We're not bullish on gaming. We're not neutral. We're not bearish or bullish. I think gaming is neutral. With or without pandemic, people play games. But the market, I believe, is mispricing recovery, consumer cyclicals. If there's a sector that I want to read more upon, this is a sector I want to keep on reading and reading, because most of the earnings upside surprises have been coming into that sector. Whether it be department stores, whether it be oil companies. I'm going to try to look at whether Earthstone, or maybe people aren't even looking at Earthstone, and then it surprises, and then 15-20% up. So I don't even think people actually priced in that Krispy Kreme is going to do well. Those types of things. For the hotel industry, I think that people are overly cautious. So I am positive. Like the numbers from Ashford, the numbers from Marriott are positive. Sure, the market may not react positively today, but after 3 or 6 or 9 months, it will be very validated. It will be validated because notice, I actually made a buy call on most of these retail names. And during that time, it was not 100% higher then. And I was also in the same theory that, well, you can't see GameStop here at $4 if people are actually buying Sony PlayStations from $4 from GameStop, right? You have to verify whether the business is truly improving. And no matter the bearish thesis, if you have a definitive fact or evidence, eventually what's nice about the US is that it will go up. Look, the reason why we can look in hindsight that stocks went up, like it doubled or it at least went higher, was because it was validated with data. At first, people are just assuming, hey, maybe TripAdvisor is bottoming out. Let's say we have a thesis that Chinese stocks in the trip sector is bottoming out, like T-Com is bottoming out. To prove that, we have to really see whether people are really traveling. And despite those COVID Delta variant cases, just match it with the quarters and quarters, and you'll get that upside. So you have to just keep on checking the data. I'd rather, and then of course we want to stick to racing guidance. Okay, so in terms of gig economy, I haven't read the results, but I think Lyft did very well. Lyft